Verti's Verbis podcast disclaimer: the information presented in this podcast is for entertainment, informational, and educational purposes only. It is not intended as legal, professional, or financial advice and should not be construed as such. Content and topics shown or discussed may not be accurate nor up-to-date information. Laws and regulations change frequently and vary by location, jurisdiction, and by nation. You should consult with a qualified legal or financial professional for advice specific to your situation. Listening to this podcast does not create an attorney-client relationship. The views expressed by the host and guests are their own and do not reflect the views of the podcast as a whole. The host is not responsible for any errors or omissions in the information provided or for any actions taken based on the content of this podcast. We are not liable for any losses, damages, or consequences arising from the use of this information. By listening to this podcast, you agree to hold the host and any guests harmless from any decisions you make, or from any losses, damages, or other claims arising from your use of this information.
Okay, folks, we're back. This episode, we're going to be talking about, again, the focus will be more on MicroStrategy and in relation to that, options trading. That's definitely a rabbit hole that I've went down on recently to kind of get more of an understanding. Now, to preface this podcast episode, neither of us are options experts or qualified traders in any sort of way or form. I would recommend people that are listening or watching to basically definitely do your own research. None of this is financial advice. There are a lot of great YouTube content creators out there that I've watched. One of them that comes to mind is In the Money. He does some really good explanations on, what options are, the nuances, the details, you name it. This podcast, we're not going to be going into the nitty gritty for options because it's very deep.
Yeah.
And the whole point wasn't to basically be another episode of this is what options is. It's more so, why are we looking into options, and more specifically, why for MicroStrategy? Okay, so that's the preface. I'm going to jump into the context a little bit. The reason why we even went down this rabbit hole was because we've been having our discussions, and we know for a fact that Bitcoin has a halving every 4 years, where the amount of Bitcoin supply gets reduced by half. That's the way it's coded. That's how it's going to continue to happen until amount of Bitcoins per new block becomes zero, right? In the year 2142 or something like that, way down there. I'll be dead by then. So because we know for a fact that that's going to happen every 4 years, that creates a cycle, right? Whether we like it or not, the market reacts accordingly. There will be a bull market where right after the halving, usually 6 months after the halving, the market has to realign because there's less supply. The market has to figure out what it wants to value Bitcoin at, so that people that want to buy the same amount can still do, but they'll have to pay more fiat or US dollars for it, right? For the same amount, because there's less now. And it usually takes 6 months after the halving for the market to kind of figure out or start to reestablish a new price. Hence, that's approximately when the bull market starts. So for us, we're currently in Q4 of 2024. And we're starting to see that, right? Bitcoin has reached a new all-time high of, I think it was 93K recently.
That's right. A few days ago. Yep.
And it's a signal to us that, hey, the bull market is starting. So that's great.
Yeah.
Based off of past cycles, usually it lasts about maybe 12 months to 18 months, maybe. Yeah. So that's a year to year and a half from now. It could be very different. Every cycle tends to rhyme a little bit, but is it exactly the same? No. So there's a little bit of a fudge factor or a variance that should be expected. Of course, you have to factor in whether there are like black swan events, right? And any of those like China banning mining or FTX exploding, that kind of stuff will cause the bull market to stop sooner because the market sentiment has lost faith, right? People are hoping with this cycle, there's a lot of positive things going on with Trump being elected, him being pro crypto, the potential for new regulatory legislation towards crypto, so on and so forth in the States. Those are all very positive signs. So there tends to be a sentiment from Bitcoiners that hopefully this bull market will be a lot longer or maybe more dramatic. So that's yet to be seen. Now, because of that fact, our discussions have basically centered around, well, with Bitcoin, we're not touching that. All right, we're believers that Bitcoin is a savings vehicle. We continue to save in it, and we put that aside in cold storage, and that's done. We're not selling that, but we do have money in related retirement savings accounts that are tax deferred or whatnot. Right, that's very common among folks in the workforce. And that money's trapped there, right? For myself, I can't touch that money until I retire. That's what the rules are. So
Yeah.
I can let it sit there and it won't really do much. Or in this case, as I've mentioned before, I bought a good portion of MicroStrategy as part of my portfolio, and it's done significantly well. I think just from the beginning of this year alone, MicroStrategy's gone up. I think somewhere like maybe around 3 or more multiples, right? So whatever amount I put in at the beginning of the year, it went up. Let's say it went up 3 times. It probably went up a little bit more than that. I'm not looking at the chart right now. So it's done well, right? And that begs the question, well, we just started the bull market, the bull cycle. Potentially MicroStrategy's value is going to continue to grow because Bitcoin's value is going to grow. Therefore, the market thinks that MicroStrategy shares should be worth a certain premium because of the fact that they hold quite a substantial amount of Bitcoin on their balance sheets. So the expectation is, at least from the Bitcoiners' perspective, MicroStrategy will continue to go up in value, especially during this bull market alongside Bitcoin. Potentially, quite a bit of a premium over Bitcoin. So the thought process is, if we know that is potentially going to happen, let's fast forward our lives a little bit, time travel, and let's say we're already like 8 to 10 months into the bull cycle, and we're saying like, wow, it really did go up substantially. Now our portfolio is like substantially larger. What do we do? Well, there's a few options. One, the safest bet is do nothing. Just continue to put in whatever money that's stuck in your retirement savings account and put it towards MicroStrategy. Do the daily cost averaging, DCA. That's fine, right? And sure, once it hits the bear market, the price will drop. But as we've mentioned before, as long as the lower price point is still higher than the previous cycle's low, just like Bitcoin, then we're still positive, right? So we don't have to worry about anything. That's the safest route. The second option, which is slightly riskier, but also has some merit, is we could try to approximately time the top of the bull market, or we don't have to time it. We could trim a little bit as we continue to climb in the bull market. That might be a safer route. And we could take off maybe, I don't know, whatever percentage we feel comfortable, maybe 5% off the top. And we'll sell 5% of MicroStrategy shares whenever it reaches a new all-time high during the bull cycle. Convert that back to US dollars because it's trapped in our savings account anyways, can't touch it. We'll park it in USD. Now, that's not a traditional Bitcoiner perspective because Bitcoiners are like, why would you want to park anything in US dollars? I get that. But in this case, we're treating our investment account or retirement savings account as an investment vehicle, right? So it gives us the ability to kind of take a little bit more risk. Whereas with our cold storage Bitcoin, we're not taking any risks on that. I'm not selling any of that. I'm going to continue to keep all of that in Bitcoin. But for MicroStrategy, because they are shares of a company, I have the option to do so. I can, do a little bit of trading, I guess. But instead of trading in and out on a daily basis, what I would think of doing is trim a little bit as it reaches new all-time highs, put that aside, and then once the bear market establishes itself, which is when the price drops to a certain point and it kind of flatlines, nothing really new happens. No, it doesn't really go up much. It doesn't really drop any further. It kind of goes within a range. That to me signals that might be the bear market bottom. It may or may not be, but if the price ranges for a good month or two, to me that feels like that might be the bottom for me at least, right? And at that point, go ahead.
Let me just go back a little bit here because it might be important to have an understanding why you're not holding Bitcoin ETFs and you're choosing to hold MicroStrategy instead in these portfolios that are quote unquote tax sheltered or not movable funds. You do have that option. Maybe you want to explain a little bit of why you're choosing to hold MicroStrategy versus holding just the ETF.
Right.
Bitcoin.
So I guess that could be an alternative, like because the way we look at MicroStrategy is it's definitely more it's it's volatile more. Is it more volatile? To some degree, because it does move in bigger multiples. The percentage change on MicroStrategy compared to Bitcoin is higher per day, or it could be it can go up more. But what I'm trying to say is it could go up higher or it could go down lower than Bitcoin in comparison, right?
Right.
So if Bitcoin goes up, MicroStrategy goes up higher percentage wise. If it goes down, MicroStrategy generally goes down lower than Bitcoin. To
So
some degree.
there's more risk and reward by holding MicroStrategy over Bitcoin itself or Bitcoin equivalents. I think the underlying part of it, you can correct me if I'm wrong, but the underlying reason behind that is because MicroStrategy does leverage itself through its
Mhm.
own shares,
Mhm.
borrowing funds to buy Bitcoin. And at any time when whether you are whatever that you're investing in, once you're putting in leverage, that means you're not just using your own money, but you're using someone else's money
Right.
to buy more than what you actually have. So I believe that's why it creates this increased risk aspect. And of course, with the increased risk, there's
Mhm.
an increased reward that comes with a company that does what MicroStrategy is doing, I
Right.
believe. And so our hope is that investing into a company like this would give you a leverage play without
Mhm.
actually leveraging yourself,
Right.
right? Because a lot of people will probably, I mean, a lot of people out there, a lot of investors out there in influencers or whatnot would tell you that leverage play is definitely not for the faint of heart or for the normal
Sure.
people, right? It's really for people that are either very degenerate or know what they're doing
Right.
and can tolerate that type of risk. And in
Yeah.
this case, we want some exposure to that, but you don't want to risk too much of it, right? If that's fair.
Yeah. And obviously, if this was any other type of stock, I wouldn't bother. There's a reason behind that. Is as a Bitcoiner, we because we've gone through a 4-year cycle, we understand there's a difference between upside volatility versus downside volatility.
Yeah.
Bitcoin produces upside volatility, right? You'll have to study fiat and study Bitcoin to understand why that is, but that's what Bitcoiners believe and understand, right? Um, and because of that, we're willing to take that long-term risk for the reward, right? By holding it
Yeah.
through a whole cycle, you'll go through all the ups and downs. But ultimately, the understanding is that Bitcoin's price will continue to go upwards and to the right, and therefore you'll be able to make back a multiple on what you invested, right, or what you
Yeah.
saved. So hence the same theory or understanding is applied to MicroStrategy. They've spent 4 years proving that they can also produce upsized returns that are greater than Bitcoin because they're leveraged. They're a leveraged play on Bitcoin. They're basically volatility on top of Bitcoin's volatility, right?
Yeah.
Therefore, that's
Mhm.
why they're returning bigger gains than what Bitcoin is giving, right? And so that's the reasoning. At the end of the day, everyone wants to make more money, whatever that means. With stocks and shares, you're playing in the fiat pond, right? Like you make
Yeah.
more you make more US dollar value with MicroStrategy shares, right? At some
Mhm.
point, sure, when I retire, I can take a chunk of that money and buy Bitcoin with it still. That's still an option. But that requires me to retire first, right? So
Yeah.
from now till then, what do I do with this money that's sitting in my retirement account that I need to invest anyways? So hence
Yeah.
MicroStrategy. Um, Back to the point, we can trim our way as it reaches new all-time highs and save that in US dollars, right? And then when
Yeah.
we hit the bear market, when we think it's the bottom or whatever we think the bottom is, we buy back
Mhm.
into MicroStrategy shares. That allows us to buy more shares than if the price was super high. That's an
Yeah.
obvious, right? So
Mhm.
that's the play. And that play has been around for a very long time. Like it's a TradFi type of tool set that can be applied to any other company and their shares, right?
Yeah.
It's just that with Bitcoin, the cycle is more pronounced. It's like for Bitcoin at least, it's guaranteed that the halving is going to occur. So therefore, the market has to react. And there you have it. You'll have your bull and bear market in 4 years time span. Because
Mhm.
MicroStrategy does the leverage play on Bitcoin, they ultimately ended up forced into the same cycle as well, right?
Is programmed into Bitcoin basically.
Correct. And so if we know that's going to happen, how do we make the best use of our money to snowball the MicroStrategy shares so we can get more of it and ultimately produce more value? So when we buy more of it during the bear market, we then wait until it goes into the next halving and then go through the bull market again, and then again trim, save it, and then buy more during the bear. And we rinse and repeat every 4 years. That's the concept, right? I'll pause there. Is there anything you want to add?
No, I mean, basically, I think you pretty much summed it up. We're just trying to extrapolate the best we can with the timings of the market cycles, because they are defined, unlike a lot of other companies where they might not have cycles of, perfectly ups and downs. A lot of them trade on news of certain things that happen, and I think Bitcoin is affected by stuff like that as well.
Yeah.
It's just that regardless of news, this cycle does still flow into that. And so with the interest that we have in investing in general, it allows us to kind of play around a little bit more in this market, I guess.
Mm-hmm.
And it's not for everybody, right? I
No.
mean, obviously, you've already told it up front. It's not financial advice by any
Nope.
means. It's just that what we're looking into. And if your job or your life, is very packed with, not thinking about investments, then maybe the right course of thing is to do is just buy Bitcoin and then just hold it and then just forget about the rest. Or maybe just buy MicroStrategy if you do feel like it's, something that after you looked into it, it fits your portfolio, works for you, then just forget about it. But what we're maybe you can call us, we're just bored. We just want a little bit more excitement.
Sure.
We want to look at it a little bit more challenging and learn a little bit more about other
Right.
things that are out there.
Right.
How do we better ourselves, with the knowledge that's out there for investing, right? And this is one of those things is that we're looking into right now. It's like, okay, how do we use this if it is something that we can use, with moderate amount of risk? Hopefully, we get a bigger return. That's the underlying goal that we have. Yeah.
Mm. It's basically trying to apply a strategy that will allow us to leverage or gain more MicroStrategy shares over time in a
Yeah.
relatively not riskless, but somewhat risk reduced approach, right? A more measured approach and not go degen, right? Now, with that said, one of the key things is, well, let's assume we play that scenario out and now we've got like, a decent amount of fiat sitting in our retirement account, which, as we all know, fiat melts like an ice cube, right? You leave it there too long, you're going to lose value. So obviously, shouldn't we invest it? So then the question came up was, well, if we're already holding proportionally a larger amount of MicroStrategy, we trimmed whatever to kind of create a buffer for ourselves to reinvest, what would we invest that in? And because we've looked into MicroStrategy for quite a while now, to Mike, in Michael Saylor's words, there is no second best, right? He says that about Bitcoin. Bitcoiners, at least the ones that buy MicroStrategy, usually say there is no second best stock. Because why? MicroStrategy buys a lot of Bitcoin. They're basically a Bitcoin proxy. So if you're going to buy a stock, would you buy a stock that has nothing to do with Bitcoin? You can. You can buy Nvidia and pray that all the narratives that come out about AI continue to be super hype and that the market continues to dump money in it. But that to me is a gamble because there's nothing like what's there other than a story, other than a narrative. But for me as Bitcoiner, I know the Bitcoin halving is going to happen regardless of whether the world thinks it exists or not. It's a reality.
Yeah.
It's in code, right? It's going to happen. So I'd much rather bet on something that I know for sure is going to happen. And in this case, I know MicroStrategy is going to be impacted by that cycle. So that's why, to me, if I'm looking at something to reinvest, it seems to be like, well, it kind of also begs the question, why would you even pull the money if you're just going to invest it back into MicroStrategy? Hence, that's why we started to think about, well, we've also heard a lot about options trading in the MicroStrategy crowd, right? The folks that hold MicroStrategy shares, what they're trying to do is they're trying to get more MicroStrategy shares as well. And how exactly are they doing that? Well, they're also constrained by the same rules. They have potentially a fixed career, that's fixed salary. money doesn't just come out of nowhere. Either you're borrowing, which is leveraging, borrowing a loan to then go buy more MicroStrategy and hoping everything works out. That's risky,
Yeah.
right? Or you're hoping that you get a raise, which may or may not happen, and you may have to change jobs to get maybe just a meager 10 to 15% increase, if at all.
That's right.
That might not mean much. So what options are there? So there's a group of folks that are, whether they're experts or just new to options trading, they're dabbling in that. And the reason why it's more tempting to look at this for MicroStrategy's perspective is because, well, bottom line, people that buy MicroStrategy tend to think that MicroStrategy will continue to have positive volatility, right? Or volatility to the upside, meaning over a long period of time, MicroStrategy's share value will continue to go up. And the question is, well, why is that? Well, because they hold a lot of Bitcoin, and they don't just hold the same amount. They're constantly borrowing, right? Converting bonds, issuing bonds, converting them, doing at the market purchases with their cash flow. They're constantly accumulating more Bitcoin. So if you've got a company that keeps adding to their balance sheet more Bitcoin, obviously they're going to be worth more. Even if they didn't do anything and held the same amount, when Bitcoin's price goes up, automatically their company is worth more because their assets went up, right? But they're not just sitting on it, they're constantly adding more. So as they add more, it keeps compounding, right? And then when the price of Bitcoin goes up, their stuff goes up even higher. So that's the concept. And so we're like, well, if the folks are looking into options, maybe we should look into it. And so I started to do a little bit of a dive as much as I can to try to understand what options is about. And options can be a very complicated topic. I'm gonna hand it over to you and give it a shot in terms of your perspective of how you want to explain it, and then I'll see what I can add to that.
Yeah. So what I think about options is what I kind of learned and read about a long, long time ago. So maybe it's a bit foggy, maybe it's not all quite right, but my understanding is sort of like this. There's two people, one's a buyer, one's a seller. Doesn't really much matter what they're buying, what they're selling, but they collaboratively want one product, right? Let's say it's chickens, right? They want to sell and buy a chicken. So the idea is the person that's selling it doesn't want to just sell it on the open market. If he did, he would just go to the open market and sell it. But instead, he wants to see if someone's willing to pay him a little bit more. And why would someone pay him a little bit more when they can go on the open market to buy it? Well, that person that's coming along to buy the chicken might not want the chicken right now. He might want the chicken later. And when he does that, he might feel that down the road, the chicken might be more expensive, maybe, in one example. And if that's the case, he's willing to lock in a price with the current seller by giving him a little bit more, hopefully that down the road when he does need the chicken, he can buy it back at the lower price, even though he paid a little bit of a higher cost up front.
Right.
That's in a nutshell of how I see option trading is. Now, there's more than one facet to this. It might not be the prices going up, maybe the prices going down, and there are different terminologies for these type of actions. But the idea is there's two people that are coming together. They want to do some transaction that will take place in the future.
Right.
So they're trying to negotiate now to the benefit of both their sides, come to an agreement, and then act out on that transaction at a later date. That's my best way of describing what I think options are.
Yeah, I think that was a great explanation, as simple as we can put it. And so let's tie that back to MicroStrategy. And as we were saying before, well, what's the benefit of doing options with MicroStrategy shares? Well, if we know the shares are going to be more valuable, potentially, let's say 1 year or maybe 4 years from now, that's basically asymmetric information or asymmetric value, right? We know something that the general market does not, right? And that's been mentioned before by the quant bros and so on and so forth, right? That's the asymmetric value, something that we have an edge on, right? And that's what we believe in, right?
Mhm.
So if we know that, then what's the best play? Well, it would make sense to potentially buy options, because as you were explaining, I can simply put down a small deposit, which they call a premium. We can think of it as a
Yeah.
deposit, upfront deposit, give it to the seller, and the seller will give me a promise, or basically a contract, and say, you get to hold the contract, and whatever period we agree to, let's say a year from now, you can come back
Mhm.
to me and you can collect those shares that we agreed to at the price that we agreed to.
Yeah.
That's what the buyer gets, right?
Mhm.
As that's the buyer side of the deal. As you explained, this what the seller gets is the deposit, the premium.
Yeah.
They can then use
Yeah.
that money up front and do something with it, right? That's great. So, back to the chicken farmer, he can take that money
Yeah.
and buy more machinery, right? And produce
Yeah.
more chickens potentially, right? Like, or increase efficiency. So there's value to that. So that's that in a nutshell is the play, right? Is to buy, like, as explained by Quant Bros, those are leaps, right? When you do a buy option, like buying the option to purchase stocks in the future, if you do it for a long period of time, like let's say more than, I forgot how many months, but at least more than 6 plus, right? So if you're doing like
Yeah.
a year, 2 years, 3 years out, those are called leaps, and it's an acronym that's short for something. I don't remember it, but basically long term, long dated buy options.
Mhm.
Um, you People can also do short selling, meaning they want to sell their shares, which is like the chicken farmer that has the chickens, and they say, hey, I have them for sale, and
Mhm.
they play the opposite side of that deal, right? So you could also sell your MicroStrategy shares and take that deposit and do something with it, but
Yeah.
there's a risk to that, and the risk is, if for whatever reason the price runs off on you,
Yeah.
when it's time to actually sell the shares, as long as you've got the shares, that's not a problem. But if you don't, then that's a huge risk, because then you have to find the shares to give to the person that gave you their deposit, because that was the deal,
Right.
right? You made a
Yeah.
promise, you took their money, you went and did something with it, but after like a year, they come back and say, hey, we had a contract, you're supposed to give me 100 shares now, and if you don't have
Mhm.
it, you're in the hole deep, because you're going to have to spend whatever amount it takes to buy those 100 shares just to give it back to the person you agreed to give it or sell it to, right?
Right.
So we're not going to go into that, because that's not my interest. And also, I'm not very well versed or understand that aspect of it. I just know that there's a lot of risk to doing those type of sells,
Yeah.
or selling options, because if I were to sell that option,
Mhm.
there's again potential risk that I don't like. Whereas from a buyer's perspective,
Yeah.
the only two outcomes are either A, I reach the expiry and I choose to exercise, meaning, yeah, I want those chickens, right? Sell me those
Yeah.
chickens now at the price we agreed. And I basically pony
Mhm.
up the money the agreed amount, and I pay for your chickens and you give me your 100 chickens. Deal's done.
Right.
The
Yeah.
other option for the buyer is
Mhm.
I hold the contract, and anywhere
Mhm.
from now till the expiry date, let's say it's 1 year out, I can choose to sell that back out onto the market to someone else that wants
Right.
that promise, right?
Mhm.
Um, so it has, in a way, it has some type of liquidity to it or value. And so
Yeah.
what I've noticed from doing the brief amount of research up to this point is, it seems like a lot of folks, there are folks that will say, I bought really long dated buy options and I bought them really cheap, meaning, I can buy the stock back at, like, let's say MicroStrategy's at 340 something right now, and maybe they
Yeah.
bought their leap 3 years ago, and the contract says they can buy it for $50 a share. Wow, that's huge.
Mhm. Yeah.
That's almost like a 7-time multiple, right?
Yeah.
So
Yeah.
it's in their best interest to put the money together, exercise the contract, and buy those 100 shares for $50 a piece,
Right.
right? That's
Yep.
what, $5,000. That 100 times 50, 5,000. $5,000
Yeah.
to buy those shares, which are worth 340 times 100, like $34,000. Yeah, no brainer, because you, after you buy it, you can flip it back out onto the market if you wanted to, and get fiat if you're so
Yeah.
inclined to. But I think
Yeah.
those people are exercising it because they want those shares, because those shares are worth 7 times more now, right?
Yeah.
So that
Right.
makes sense. Now, there are the other folks where they're like, I bought a whole bunch of these contracts. I plan to buy I plan to buy one contract worth, which is 100 shares, but I've got like
Mhm.
maybe 2 more extra contracts that I bought that are worth a lot of money, but I don't want to, I don't have enough money to exercise those other contracts. So what they do
Right.
is they can sell back out those contracts before the expiry and
Yeah.
get paid a huge premium, because their premium grew instead of shrank, right? Because the
Mhm.
price went up, therefore their premium also became more valuable.
Right.
Okay.
Right.
So that's the deposit that we're talking about. But you're kind of thinking, well, wait a sec. Isn't that deposit already given to the seller? Yes, the deposit is given to the seller. They take it and do something with it. But there is kind of like a perceived premium to you as a buyer holding that contract.
Well, it's like a new deposit, right? Like it's a deposit on top of deposit now, right?
Kind of.
It's like basically more value is there's the premium has grown
Right.
now because of the value of the underlying in this case the stock of
Right.
MicroStrategy has gone up.
Yeah.
So now it's no longer just worth the premium is no longer that small anymore.
Right.
It's bigger and you're capitalizing on the difference
Yeah.
that you paid versus what you can sell it for now, which is higher, I guess, right?
Right. And so the original buyer can now
Mhm.
become a pseudo seller, right?
Right.
Because the
Yeah.
premium that they paid is already paid to the seller, the original seller A. That
Yeah.
person's still there, right? They did whatever they wanted
Mhm.
with that premium. But the perceived premium on the buy option, right?
Yeah.
What you put, the deposit you put down,
Mhm.
that perceived value grows because now the stocks have gone up over a year's time. Let's say you
Mhm.
put down a deposit of 500, that deposit has now become $2,000.
Yeah.
Well, but it's perceived. It's not there until you sell your contract to someone else. So another
Right.
buyer has to
Yeah.
then agree with you to buy the contract off your hands. And what they
Right.
do is they give you the upscaled premium, and then
Mhm.
you walk away from the deal. And so you end up with the new premium, which grew over time. And the new
Yeah.
buyer now has the contract with seller A. He
Yeah.
replaced you, right?
Yep.
And that's
Yep.
basically like it's almost like, think of it as like flipping houses, right? That's kind of how I look at it. Is
Mhm.
my perception of what the market is really doing is, yes, there are people that honestly do want to buy the shares when it expires, but you don't get the
Mhm.
premium, right? The premium only exists if you sell your contract to someone else. If you don't
Yeah.
sell it, the premium doesn't exist, right? You're
Yeah.
basically just
Mhm.
buying the shares. So there's that, so-called, they mentioned decay, right? Your
Yeah.
premium will decay as you get closer to expiry. Because why? Because as you get closer to expiry date, no one wants to pick up your contract because there's no flip.
Yeah.
You can't flip it again. People like to
There's no
flip
time
it to
left.
make money. Exactly. The time
Yeah.
is so tight, there's no way to flip it.
Yeah.
Therefore, the value of your
Mhm.
premium diminishes. And the only
Right.
person that would hold a contract would be someone that
Mhm.
actually wants to get and buy those shares, right?
Yeah.
But I
Mhm.
suspect the majority of the market are simply just flipping options to each other until someone is left holding the bag and they're like, dang it,
Yeah.
I don't have enough time to sell it. I'm going to have
Yeah.
to eat it. That, or I buy
Yeah.
the shares. And they might not want to because they have to fork out whatever the contract says they need to pay for those shares. Those shares aren't free, right?
Yeah. That's right.
So
Yeah.
anyways, so that's what I've learned. Anything you want to ask or add?
Nope, just that one thing about the leaps, leap basically stands for long-term equity anticipation securities. So
Mm-hmm.
exactly what you were just talking about is like a longer form of a contract, right? It's a long contract, right? That's why it's called leaps. I guess they just like to have their acronyms
Yeah,
also mean something. So um that's basically it. I just wanted to add that part because I thought it was kind of neat to know what it was. Yeah.
absolutely. Absolutely. I think some of the things I also learned from, because I decided like the only way to really learn is to basically practice it, right? Or have some skin
Right.
in the game. So what I did was I took a very small amount. I tried to find the cheapest options and only bought, I think in the end I only bought three.
Yeah.
And I picked like different expiry dates. So the first one I picked expires within 30 days, right? That was the contractual agreement. The second one I bought expires in about 60 days. And then the third one I bought expires in about 90 days. And in a way, it gives me a better feel for, how are they different? There's a lot of numbers and stuff, right? So it's hard to wrap your head around. But what I've noticed is that decay on the premium is real. Like, not to say it's fake, but it's real in the sense that as it gets closer to expiry,
Mhm.
even if your premium is perceived to be high,
Yeah.
you may or may not be able to find someone to buy it off you because you're running out of
Right.
time, right? That's a
Yeah.
reality. So therefore, like people who did leaps where they did like 1 year in advance or 2 or 3 years in advance, that's way more
Mhm.
beneficial because they don't have to wait until like the last 30 days to sell it. They could sell it maybe 2, 3 months before the expiry. Tons of time and tons of people that want to
Mhm.
flip that, right? That would make
Yeah.
more sense. So if anyone were to potentially look into doing leaps, they should do it for a longer time period, which makes sense because that aligns well with MicroStrategy, giving MicroStrategy shares time to accumulate value, right? That works, aligns really well. If you
Yeah.
do it too short of a period where it's 30 days, you're kind of stuck trying to flip it as soon as possible. And so that's a lesson learned, right? That also ties into liquidity, which is basically, is there enough people that you can flip it to get out of that trade or to get your premium, right? You may even lose money. So if it's not liquid enough, meaning there's not enough of demand for your contract, you could be
Mhm.
stuck with that contract regardless of whether your premium is up or down, right? So you can't get out of that
So
trade.
you could lose your premium. I think the main thing
Yes.
is that what you can lose maximum is the
Hmm.
premium,
Correct.
right? Because you're never obligated to
Buy.
exercise or
Yeah.
buy the shares
Correct.
unless you want to.
Right.
And if you don't want to, you just lose out on the
The premium.
chance,
Yeah.
which is the premium
Yeah.
that you paid for the chance,
That's
right?
right.
Um, do you feel that then everyone that would be playing in with leaps would also max out the duration then? Um, because it's everyone's looking forward, or I should put it this way: what's why wouldn't anybody just
Oh,
why
just go
why
maximum
would
3 years or
yeah,
something
why
like
does
that?
everyone just go maximum? Yeah, why even think about doing a shorter tier time? Is it because they tie up capital? Is that the reason why?
Capital aside, I think they have to also be aware of the cycle, right? It ties back to the Bitcoin cycle. So
Okay.
if you buy a 3 year, let's say a 2 year expiry right now, starting today, and
Yeah.
expires 2 years out, you could very well hit the beginning of the bear market.
Hmm.
So there's a little bit
Right.
of that. Again, that the risk is you have to kind of time it, right? If you don't time it,
Yeah.
then leave it alone. The risk is relatively lower. But if you have to then factor in
Yeah.
like, oh, now you have to make a judgment call. When do I
Hmm.
think the bull market's gonna end and the bear market starts? And then you kind of have to like tie in, or when do I start, buying my options, the leap for it, so that it
Hmm.
times well with the next bull market start. That would be ideal because by the time it nears expiry, it's starting to go up in value way more. And then you can sell it
Yeah.
before it expires. That would make the most sense. So I
Mhm.
suspect, and from what I've heard, is from the Quant Bros podcast and stuff, is that's what they did. Like quite a few of them did
Yeah.
leaps early on, right? Whether maybe
Yeah.
because they thought, hey, it's less money to put down, they don't have to buy the shares,
Yeah.
or they decided that's also a good way for them to make this type of leveraged approach play, right? And it's worked very well
Yeah.
because a lot of them, again, got in really early and their contracts are like very cheap compared to what
Yeah.
you'd have to pay now. And they're coming to expiry
Right.
soon. So then they
Yeah.
can then flip it and make a lot of profit off of the new
Mhm.
premium, right? And so that's the thought, right? Like if we put aside a certain amount of fiat, ideally, you would potentially want to look into maybe a portion of that fiat, apply those into leaps for the
Yeah.
and in anticipation for the next 4-year cycle halving, right? So that
Mhm.
we can do the same play. Now, again, I think one of the things it's unknown right now is the market isn't stupid, right? The market makers, especially, they may initially think that MicroStrategy is a zombie company, therefore isn't worth anything. Therefore, their options are really cheap. But once they start
Yeah.
seeing the price growth, especially with multiples of like 3 to 6 times over a 1 to 2 year span, they're gonna
Mhm.
reprice their options, and they've already actually started
Oh.
doing that, right? They basically
Yeah.
jacked
Mhm.
up either the amount of the premium that you have to put down,
Yeah.
or you have to jack up how much the new price you think it's going to go to. So they're not going to make it cheap for you
Right.
to play, right? Either it's going to cost
Yeah.
you a lot upfront, or it's going to cost you a longer time frame for you to hit.
Does that mean that the good days have already gone?
I suspect
Or
that the early plays are done,
yeah.
again, but again, does the market maker fully understand how Bitcoin and especially how does MicroStrategy
Right.
work? What they've seen so
Mhm.
far is the leaps that have come to expiry, and they realize, holy, those dramatically grew, right?
Yeah.
They'll try to factor that into their algorithm to spit out what is the projected new terms we should use, whether it's the premium amount versus the new strike price, right? The target price.
Mhm. Yeah.
But again, whatever calculation they're using, it's not factoring in the growth of what Bitcoin and MicroStrategy can do, because they're not linear,
Yeah. Yeah. That's true.
right? They're like exponential almost, right? So or
Mhm.
non-linear at least, right? Where that's why the market maker first of all would have to become a fully understanding in Bitcoin, and then
Mhm.
fully understand why MSTR is different from other companies, and then they would
Yeah.
have to retailor their algorithms or whatnot or calculations to properly realign those buy or sell options.
Makes sense.
But again,
Yeah.
they'll catch on sooner or later. But again, will the performance outpace them? And that's the
Yeah.
bet.
Because they have to.
Yeah.
Because if no one's if they set it too high or too intense,
No one's going to
and
take it.
also no one's going to start trading, right?
Yeah.
So they had to find a good balance, and it really
Sweet spot.
depends on how things kind of flow going forward, right?
Yeah.
If the market starts like going towards a bear, then they might have to loosen up on how strict they put these things. So
Mm.
it's a good time, I think, for all of us to do more research now,
Oh, yeah.
and then kind of have it in our tool belt so that we can use it when the time comes that, oh, maybe this is a good time to use the what we looked into in the past right now to kind of benefit from it, right?
Yeah, absolutely.
Yeah.
And then one way to explain market maker is just think of it as there's two ways you can think of it. If you go onto an
Mhm.
exchange to, let's say, buy Bitcoin, there's usually a
Yeah.
spread, right? And the
Yeah.
spread is where the exchange makes money. It's basically they don't care whether you're buying or selling Bitcoin. Every time there's a
Mhm.
transaction, they're going to take a cut, and that cut is coming from the
Yeah.
spread. So the spread is basically the amount that someone's willing to offer versus the
Mhm.
amount that someone's willing to sell at. And there's a gap.
Right.
They
Mhm.
widen that gap so that you can't see what falls within that gap. And whatever that falls
Mhm.
in, they take the profit off of that. And
Right.
so if you're trying to sell, you're trying to buy Bitcoin at a certain price point, let's say at 91K, the exchange will say, no, it's going to cost you 92K to buy it. They force you to
Yeah.
buy it at a higher price because why? They take that 1K difference and that becomes their profit,
Yeah.
right? The same thing
Right.
happens with the options market makers. There's a bid ask spread. Same thing.
Yeah.
Bid is someone willing to buy it at, and the asking price is, well, that's what I'm willing to sell it at. So they've got to meet in order for a transaction to take place. What the market maker does is they play both sides, right? They know for a
Mhm.
fact that if they set up options, set up an options market, if no one
Yeah.
places a bid and no one places an ask, there's no action. So what they
They're not
do
making money.
is they play both sides. They'll
Yeah.
offer the side that wants to sell a bid, and they'll offer the side that wants to buy an
Oh.
ask. And then they
Yeah.
hedge, right? They
Oh.
hedge it so that they try to make it so that they don't lose money in the grand scheme of things, and also are able to make a
Yeah.
little bit in between. That's what they're
I
looking at.
see.
they're playing the gaps between the bid and the ask, or the spread, right? That's how they're trying to make their money. But so therefore, that's why that's understanding. Think of the market maker as the casino or the house. You go to the casino. Casino is like come and play, right? But they make the money through, you know, all the spreads built in, the odds built into each of the games you play, whether it's blackjack.
It's sort of like you go into a poker room and there's no players there, and the casino's like, let's hire some people to come in and
play with you,
so that you guys have a game to go on,
exactly.
so they can try to make it happen, right?
Right.
Like, okay.
Exactly. So that's interesting. And so why am I bringing this up is because the more I look into options trading, the more my understanding or my feeling that I take away from it is it's all gambling. Like I'm really generalizing it, but at a very high level, everything is gambling. It makes me hark back to the days where I've had family members tell me, and great uncles or whatnot, say, oh, you know, the stock market is great investment vehicle, makes money, massive returns. It's like, you know, definitely do. And there's always been conversations, you know, during dinners or whatnot, like, well, isn't that just gambling? And then they argue, no, it's not. It's an investment. And then lo and behold, you know, a whole bunch of years back, there was that major mortgage issue, financial crisis. That was back in, that was 2008, I think. And all the mortgages, no, not mortgages, all the, what do you call them? There's a certain type of vehicle before ETFs. I forgot. They were very popular back in the day. I forgot what they're called, but it was an investment vehicle, and those all crash and burned, right? But they were very popular back in the day, and everyone saved their money in those because those had fixed returns, right? Everyone was looking for that.
Yeah.
That didn't do well after 2008, and then all of a sudden ETFs started popping up and became more popular. So again, to me,
it's just one of those things.
Yeah, it's gambling. That's how I see it.
I think our channel's really based on everything that has risk and reward, right? Gambling is big part of that, you know, and everything that we talk about, from, you know, trading card games, which has a gambling aspect to them, to actual casino gambling, to stock market purchases. I think that is our theme of things that we like to talk about and discuss. We try to find out where the house edge is, and if, you know, if we have a little bit of advantage, then we can play to that. And if we don't, then we got to be careful that, you know, at the end of the day, you can lose all your money, right? And it's just something you need to know, and everyone else listening out there needs to know as well too. That's why it's not financial advice. It's just two guys talking about gambling, basically.
That's right. Definitely treat it as such. I think going forward, we'll have additional podcasts that tie back into this topic, because we want to revisit. It's been, you know, another 30 days or whatever. How well did it do for the first contract? And then another 30 days later, how well did we do with the second contract? And then we'll be able to give feedback of what we learned, what's different, were there misconceptions, right? And so it'll be a good follow-up piece for us.
Absolutely.
With that said, I think it's probably a good place to stop it here for this one.
Yeah, sounds good.
Okay, thank you very much.